Hello, everyone. My name is Andrea Armeni. I'm the Executive Director of Transform Finance and the convener of the Transform Finance Investor Network. And it's my honor to welcome you to today's presentation, a webinar on the collaboration between the program and investment sides of foundations to drive overall mission. I'll be joined today by Meredith Benton, a longtime collaborator of Transform Finance from Whistle Stop Capital, Elizabeth McGeveran from the McKnight Foundation, and Laura Campos from the Nathan Cummings Foundation for what promises to be a very interesting discussion going through some of the practices that McKnight and Nathan Cummings have been pioneering in this space. So I will turn it over soon to Meredith for her introduction. First, a couple of updates on our end and a couple of framing notes, as always. In terms of updates, as you might have heard if you've been following our work, we have launched a cohort of worker justice organizations that will be working with us for almost a year in discovering capital-facing strategies that can support their existing strategies. Looking at new ways in which they can engage with pension funds, for example, how they can set standards around high road employment in the case of muni bonds and similar activities. If you're interested in supporting their work and you come from the finance side in particular, several of the groups that are joining us from the SEIU Capital Stewardship, Jobs with Justice, National Domestic Workers Alliance, we'll be looking at issues around real estate finance, private equity, municipal finance, and we're looking for experts and coaches that can support their work as they explore more and more how they can figure out this new flanks for worker justice that, as you all know, has been largely under attack. So please do reach out to me if you have something that you would like to contribute or if you're interested in learning more about the cohort of the future of workers. Our next webinar will be picking up on the presentation on accountability for private investors and how that has learned from the accountability of multilateral institutions that we did with Accountability Council last month. It will be with an organization called CELA that is pioneering a new model for impact investor accountability, and with Joanna Levitz here that many of you might know from her work at Thousand Currents and with the Buenvivir Fund. Lastly, on the Investor Network, we will be sending to those of you that have been participating actively a survey soon to see how we can improve our work. What is helpful for you, the format works, what would you like to see more of, and the like. If you don't mind responding to that survey, we'll keep it efficient. It would really mean a lot so that we can serve your interests better. And in the same vein, tell us what topics are on your mind for webinars, for investor briefings, for presentations of live deals. I'm glad to report that the last presentation that we did was the live deal for the New Hampshire Community Loan Fund around their effort to raise capital to finance the conversion of manufactured homes parks to resident ownership, especially in the face of the wave of private equity acquisitions of manufactured home parks that can displace residents or can increase their rents. And of all people, that topic was picked up by John Oliver on his show, which gave the issue a little bit of visibility. And we wish the New Hampshire Community Loan Fund all the success in the world, given the great work that they're doing. So if you have similar topics or opportunities that you'd like to see more of, please do let us know. We're always open to suggestions and feedback. Now, on today's topic, the collaboration between the program and investment side of foundations. This is something that perhaps doesn't need too much background presentation given the crowd that we have here, but just to put us all in the same place. Historically, I would say the two sides of the house have been deeply separated, right? Going back to the Andrew Carnegie idea of maximizing your profits in your regular life so that you can give more to philanthropy. That idea was perpetuated even through probably less than 10 years ago at the Gates Foundation, with the idea that the more you maximize returns on the endowment, the more money you will have available for disbursements through grant making. And there was, of course, a realization that there is a deep connection between what you're doing on the investment side and what you can do on the grant side, on two fronts that came almost to meet in the middle. One of them was this idea of not investing across purposes, right? So if you are a foundation funding health in communities, probably you shouldn't be making money from tobacco. Especially since the amount of money in the endowment vastly exceeds the amount of money that is expended in grants. Going back to the Gates Foundation, just because it comes to mind, not to pick on them, their investments in the Niger Delta were, in a sense, creating the demand for the work that they were doing on the grant side around health for communities that were affected by toxic fumes. So one realization was, that we don't want the endowment side to be undermining what we're doing on the grant side. But the other was that investments, of course, can also be a way of advancing the goals of the program side, right? And the birth of program-related investments in particular as a way of contributing and complementing the work of grants. Now, we want to look a little bit more, though, at a conceptual integration between the two. So not just the use of the capital, but also the voices and the knowledge that is produced on the program side, and how that can and ought to inform, from my perspective, the work that happens on the investment side. And this growing interest in the integration has really come to the fore with some of the really prominent critiques of philanthropic activity that we've seen even this last year with the writings of Rob Reich, of Edgar Villanueva on decolonizing philanthropy, and Anand Giridharadas on Winners Take All, right? And this has really led philanthropy probably to challenge itself a little bit more on how it is that the two sides fit together, right? Are we really doing something that is meaningful here? Now, more positively, why does it make sense to increase this integration? And I would say from the usual Transform Finance perspective, there is this aspect of fulfilling the mission, right? How do you justify your existence? I remember when Malcolm Gladwell was saying that Harvard is a hedge fund with an educational institution attached to it, right? We wouldn't like the same thing to be said about foundations. We'd like the core to remain the mission and how that mission gets fulfilled. But it can also be a way of risk reduction, which is always something that ends up being more appealing to the investment side of the house, right? All the knowledge that program officers are exposed to, all the knowledge that grantees can bring about, can be a way of de-risking investments and understanding what is really happening out in the world. So I think that is one way in which we can sort of push this agenda of integrating the two sides. More on the philosophical bents that I tend to go down on sometimes, I would say that I would like the activism on the side of foundations, right, which is still fundamentally investor-led activism, to be subsumed to the social change agenda. That is to say, when we see investor-led actions on a variety of fronts, oftentimes it is this, investors got a wake-up call and they say, oh gosh, we need to work on this particular issue. We need to file a shareholder resolution, this or that. As a best practice, that is done in coordination with activists, with grantees and others that have this information, but it's not always done in a way in which we try to see how that investment activity actually supports the broader activist agenda, right? It's two separate flanks that run in parallel. And I think that fitting the investor activity as a broader part of a social change agenda can also increase the legitimacy for those decisions, right? You can say, why is it that I am taking a particular position on engagement, divestment, or type of concessionary capital that I might be in a position to provide? Well, that is because it fits within what the activists or those that are sort of owning the social change agenda, not just because they sit on capital, but because that is their daily work, have established as part of the work that needs to be done. Now, for all the efforts that there have been, clearly we haven't seen enough. I think it's because of some of the fundamental pain points that exist there. And there is certainly a lack of a shared language between the program side and the investment side, right? You put them in the same room and you drop in the word equity. Probably one of them thinks of it as share ownership, and the other thinks of it as equity as a form of justice. And they're really oftentimes talking past each other. And this has reinforced a degree of mutual mistrust, right? A lot of activists say, oh, no, finance is something that is out there and that is bad. It's perhaps a necessary evil since it pays my wages, but it's not something that I want to engage with. And reducing a little bit that mistrust and clarifying, as Laura has done with us through our institute in the past, that no, actually, there are investors that are very much on the same page. They're trying to work towards the same agenda, right? We can't have such a black and white notion of the world. So that is one of the pain points that we can take away. And also clarifying the relevance of each other. As I said about the risk, right? If we highlight that the information of the program side and of the activists is relevant to the investors, and vice versa, that investment decisions are relevant to social justice outcomes and to activist outcomes, then there might be a little bit more of that willingness to engage. And finally, the point around inertia, right? People have done things the same way. Certainly, investment officers at foundations and elsewhere are fairly happy normally to just continue with their life and doing things as they've always done it. And we'll need to find the right pressure points in some way to get them to move past that and modernize their practices a little bit. So things that I would like to explore after Meredith, Laura, and Elizabeth's presentation here would be really what can be done, what is currently being done, what still remains for us to be done. I think highlighting these benefits will be a good way of getting other foundations to jump on this integration bandwagon, let's call it, to see what that it has actually worked fairly well, that it has been meaningful for both sides. Enabling the program side to have these conversations meaningfully with the investment side, right? So probably some background trainings on what is it the investors care about? How do you talk to them? What are these asset classes that they talk about, and why is it that they can't just divest from fossil fuels and put all that money in worker co-ops and startups, right? Getting the program officers to understand more and more of that, so that their suggestions to the investment side are a little bit more absorbable, perhaps. Putting the grantees in a position where they can share their knowledge, right? Where it actually becomes a custom or something that is done fairly consistently, where there are these channels of communication, and it almost becomes a default that when a decision is being made, they are consulted, or somebody thinks, oh, surely we have somebody in our circles that knows about this issue from their lived experience or from their day-to-day activism. Let's try to talk to them and see what they have to say about that. So that's a little bit how I'm looking at this conversation. I invite everyone to chime in via the chat function that you'll find somewhere on your screen, depending on what operating system you're using. Or you should also be able to unmute yourself if you would like to speak up directly. And with that, I will turn it over to Meredith. Meredith, thank you for organizing this webinar and for having been such a fantastic collaborator for us throughout the year. So over to you.
Thank you, Andre. I'm delighted to have this conversation. So I'm the principal at Whistle Stop Capital. Whistle Stop Capital works with foundations and other asset owners and advisors, and we look at ways that we can increase the social and environmental impact of the portfolio of holdings, right? And I've been in this space for a very long time. There I am. I've been in this space for a very long time doing shareholder engagement, doing social research on companies. I've done business development. I've led, managed client portfolios. And over this period of time, I've done a lot of outreach to activists on the ground to make sure I understand their issues well, right? To make sure that I'm representing them well when I do shareholder engagement, to act as a bridge between their concerns and the conversations that we're having at the companies. And at the exact same time, I would also be trying to talk to the folks who are providing their grants, right? Saying, join us in this initiative. It's really important because we've been hearing from your grantees that this matters. These communities are being impacted. We need to move forward around climate change, around human rights in the supply chain. Can you join us doing this investor work? And I kept finding this absolutely perpetually perplexing firewall, the firewall that kept existing, where it said, oh, that's not really, I can't help you out with that connection, or I'm not really allowed to have that conversation. And I'm thinking, I don't understand, because here I am trying to make the links from a different perspective with a different goal, but why that firewall exists has never made sense to me. So I'm absolutely delighted to have this conversation today. I sort of consider myself the first person in the first row at the masterclass that Elizabeth McGeveran and Laura Campos are going to provide us with to help us understand what's happening here. Why has this friction continued to exist for so long, when from my perspective as an outsider to the foundation world, it just doesn't make sense to me why these limitations exist. So with that, I will say that I have been very lucky to work with Elizabeth and Laura over the years. I know them for their intellect, for their commitment to the field, for their thoughtfulness in the work they do, and how effective they are in doing their work. So I can grant to anyone on the phone or anyone on the webinar who don't already know them that this will be engaging and interesting conversation. I'll start with a quick introduction to Laura. She'll be speaking first, I believe, with your slides. Laura is the Director of Corporate and Political Accountability at the Nathan Cummings Foundation, where she does both grant making and active ownership strategies. She's relatively unique in the field in that way. She can tell us if she has peers, but from my perspective, she is peerless, right? And she engages both. I've worked with her doing shareholder engagement and advocacy work, and I also know that she very much thinks about the way that her grantees are impacted by the conversations that we have. Elizabeth, who will go next. Elizabeth McGeveran is the Director of Investments at McKnight Foundation. Elizabeth has led a board-initiated program to reshape the investment priorities at that foundation. She also worked for a number of years leading socially responsible investment initiatives at F&C Asset Management, a very large London-based asset owner, and she's been involved with and on advisory committees for such niche companies as ExxonMobil and General Electric, helping them think through what they can do or how they might improve, encouraging those improvements that they might make. So with that, I'll pass the baton over to Laura, and she can tell us a little bit more about who she is and the work that she does.
Am I able to be heard? Okay, great. Okay, so I am the Director of the Corporate and Political Accountability Portfolio at the Nathan Cummings Foundation. And if you want to flip to the next slide, just a little bit about the foundation. The Nathan Cummings Foundation is a multi-generational family foundation. It's rooted in the Jewish tradition of social justice. We have an endowment of roughly $450 million. And our mission and our programs are really focused on addressing two key challenges: climate change and inequality. And sort of underlying that broader mission, we have 4 different program areas. So we have the corporate and political accountability portfolio. We have an inclusive clean economy program. We have 2 streams of voice, creativity, and culture work. And then we also have a racial and economic justice program. About a year ago, a little over a year ago, the foundation, after a process with our board, took what I think is a really bold move and committed to aligning 100% of the foundation's endowment assets with its mission. And so we are in the process of working through that commitment to really align everything in our portfolio with our mission. I think that in part our decision to do that was helped along by the foundation's really long-standing commitment to shareholder activism. Over the last, let's see how many years, I think we started, our first proposal was filed in 2003. We passed shareholder activities guidelines in 2002 with our board. So over the last roughly 17 years, the foundation has filed more than 200 shareholder proposals. And all of those proposals have really been based on dual criteria. So the first thing that we look at if we're going to consider being involved in filing a shareholder proposal, or indeed leading a shareholder proposal, is whether or not it aligns with the foundation's broader mission or with its individual programmatic goals. And then we also look to ensure that if we're going to be filing on something, it also has potential implications for long-term shareholder value, and that we can make a successful and compelling argument to other investors as well as to companies about, why this environmental, social, or governance issue that we filed on is something that, from a shareholder value standpoint, because that's really the language that investors and companies often speak, is going to make sense for them. So let's flip to the next slide, please. So as I said, we do have sort of a broad-based commitment to align all of our assets with our mission. And we're still working across all of our programs and assets to do that. I would say that I think at this point, our shareholder activism could not be more fully integrated into our program. As Meredith mentioned, I am part of the program team. I'm a program director. I have a grants budget as well as responsibility for overseeing, with some help from Meredith actually, all of our shareholder proposals that we file. I attend all the program team meetings. It would be difficult for me to be more integrated into the program team. And as Meredith mentioned, the corporate and political accountability program also employs both shareholder activism as well as grant making to advance progress on the 2 sort of large goals of the foundation: addressing climate change and addressing inequality. I would say that we really believe in the power of this. And I have been very fortunate to have been given a position where I could actually put some of the foundation's funding resources behind the power of this. So the corporate and political accountability portfolio has sort of like 3 main strategies that it's looking to advance within that work. One is looking to sort of decrease concentrated corporate power, and that relates to competition policy and antitrust work. We're also looking to leverage corporations as allies where we can. And then finally, we're doing quite a bit of funding around a third piece, which is activating investors as agents for change. And so that's where we've been able to support with our grant dollars quite a bit of the work going on in the active ownership field. We have been able to partner with really, I think, important and key groups in this space, including, I think, some I saw registered today. We have been longtime partners of the Interstate Center for Corporate Responsibility. We're supporting groups like First People's Investment Engagement Project, Open Mic, Series. So it's really sort of integrated in a way that you're just not able to look at them separately anymore. Next slide, please. So, I was asked to speak a little bit about both how investments and the investment functions in a foundation can support program and vice versa. And for me, I think, it's really clear if you look at it in the context of our shareholder activism work that it's definitely a two-way street. They do support each other. In terms of our investments, and in this instance, in specific, our publicly held equity investments, we are able to use those investments to submit shareholder proposals on a whole range of environmental, social, and governance issues that really do have really important implications for our mission and our program goals. And some of the things that we've been able to do with those over the years, I mentioned we filed more than 200. Some of the key things that we're looking to achieve and that we sort of judge ourselves on when we're trying to determine whether or not a particular shareholder proposal or shareholder engagement has been successful is things like, are we able to use a shareholder proposal to draw attention to problematic practices? So just one example of a way that we've been able to use our investments in a public company to draw attention to problematic practices with direct implications for our focus on climate change would be a proposal that we filed a few years ago at Chesapeake Energy, asking the company to eliminate the use of a problematic metric from its compensation plans, and that metric was the reserve replacement ratio. And what it did was essentially it incentivized executives at Chesapeake Energy to continue to sort of locate and drill for additional reserves of fossil fuels, irrespective of whether or not that was profitable. So not only potentially bad for long-term shareholder value, but also certainly bad for the climate. We filed a proposal there. The proposal didn't actually get tons of support from other investors, but it did sort of help to spark, along with other filings of the same type, 2 full-length articles in the Wall Street Journal looking at the use of this type of problematic practice in the oil industry in general. So that would be an example of a way in which we've been able to use our ownership of a company and the shares we hold in a company to raise an issue and draw attention to an issue that is problematic for our program areas. We also use our standing as an owner to create space for our partners, our grantee partners, and our allies. And, I can give any number of examples of how we've been able to do this. One that's sort of top of mind because it's currently happening is some work that we did with grantee in our racial and economic justice portfolio. That's the Action Center on Race and the Economy. Around a year ago, they produced a report looking at how Amazon allowed its various platforms to be used to really distribute products that were offensive and linked to sort of hate speech and white nationalist groups, and that's really problematic for any number of reasons. So we took the report that our grantee produced and we said to our grantee, do you think that it would be helpful for us to develop and file a shareholder proposal based on some of the findings in this report as a way maybe to sort of crack open the door to talk to this company, which has been really hard for people to get to talk to? And so our grantee said, yeah, it couldn't hurt, right? So we took the report, we turned some of the key findings into a shareholder proposal. We filed the proposal. Lo and behold, it did sort of create some awareness at the company that the concerns raised by the report hadn't fallen on deaf ears. They weren't going to go away. And so the company did have a conversation with us about our concerns. I would say, unfortunately, when we actually raised the possibility of having them speak directly with our grantee, the conversation ended fairly abruptly. But we now have an opportunity as a sponsor of a shareholder proposal that is on the proxy ballot at the company's annual meeting next month to send a representative from our grantee to the company's annual meeting where their full board of directors will be, and that person will have 3 minutes to talk to the company and the board of directors and all of the company's shareholders about why this is a problem and what the company could be doing better. So that's an example there. And then I would say finally, like the ultimate goal of all of this work is to actually change corporate behavior. So not just, draw attention to problematic practices or create space for people to talk to companies about the things that they're doing, but to actually change corporate behavior. And we have many, many examples of that. Again, I can turn to some of the most current examples, which would be proposals that we filed with our partners at Ceres, which is also a grantee of ours, on renewable energy usage, really looking at large corporate customers of energy and asking them to commit to establish renewable energy goals as a way really to sort of indirectly push utilities to begin to generate more clean energy. So we filed at a number of companies. We withdrew 2 proposals this year at Goodyear Tire and at Harley-Davidson, both with sort of some significant presence in the Midwest. And I think both in some ways like some fairly iconic American companies, and both of those companies agreed to undertake work to assess, the feasibility of establishing renewable energy goals and to actually then announce goals for that. So that would be just one instance where we've been able to use our standing as an investor with shares in a company to change corporate behavior in ways that we think is going to be not only good for our programmatic interests, but good for the company's long-term bottom line. In terms of how can programs support investment, I would say in some ways, program can sort of serve as like the canary in the coal mine, right? Like it can be an early warning indicator of issues that over time may absolutely become material for a company, its investors, and the bottom line. I was looking through some old presentations I did the other day, and there was a bunch of things in there about, these things are definitely material. It may look like, BP wasn't necessarily doing the best job of managing health and safety risks, and oops, they had an explosion on an oil rig that resulted in something, I think it was like a $10 billion fine. It's been years now, but something that was clearly material. We've seen much more recently the bankruptcy of PG&E, which the Wall Street Journal and Forbes both said was the first climate change bankruptcy we've seen, but most certainly not the last climate change bankruptcy we're going to see. So again, very material for a company in this long-term bottom line. I would say that there's growing recognition not only of environmental issues being material, but also of social issues being material for the bottom line. And I do think, again, that it's the grantees that are really on the ground looking at these issues, thinking about how they're being impacted by the ways in which companies are operating that can really sort of surface issues before they become actual sort of bankruptcy issues, right? So for me, there's a clear two-way street in the ways that both program and investment can support each other. So I'll wrap it up there.
Great. Thanks, Laura. Very, very helpful context setting. And I know a few people have noticed that they can use the chat function to put questions in. So I will pay attention to those and be sure to share them out after Elizabeth has had a chance to introduce herself. I will say for Elizabeth, for people who haven't worked with her in the past, a quick anecdote is that when I first joined the field, right out of undergrad, and I was sent to a meeting and I didn't feel prepared for the meeting, and I was talking to my coworkers, and I said, well, what do I do? I'm not sure if I'm prepared. I don't know what to do. I'm not going to know what to say. And they said, whatever Elizabeth does, you do. And that was my guidance note, and it's something I don't think they've been wrong about, and continues to be true that Elizabeth is a leader. So with that setup, Elizabeth, do you mind telling us more about your work?
Well, I have never heard that anecdote before, so it's a good thing because you should probably question your colleagues' wisdom, I think. But thank you for inviting me. It's really a pleasure to be here, and this is one part of my job as the director of the McKnight Endowment that is the most that I am the most passionate about, which is how do we work between the investment function and the program side to deliver the kind of financial returns that the endowment needs to engage in our primary business, which is grant making, and how do we also, as investment staff, add value that makes it easier for the program officers to do their jobs and makes us a better grant maker. So just for those of you who don't know the McKnight Foundation, we are based in Minneapolis. We are money that is originally from the first 3M, the first CEO of the 3M Corporation. Today we have about $2.3 billion in our endowment. About 70% of our grant making is in the state of Minnesota or stays pretty tightly in the Midwest, so we are a place-based investor with some national and international work. You see here on this slide, these are the lists of our 8 program areas that are very diverse, all important, but not necessarily intuitively always connected with one another. So we're working from a very broad palette of grant-making priorities. One of the things I think that's been really helpful in our impact investing and our investing program in general is we agree as a foundation that we don't express all of our values through our grant-making portfolio. There's many things we believe in and cherish and support that do not receive grant-making support from us. And similarly, we apply that same theory to the endowment. Our investment endowment cannot and will not express every value that we have as an institution. And I think that allowing ourselves to be a little bit more limited in where we express values through investing has enabled us to kind of go further and faster than if we were trying to kind of be every single thing to every person through our investment strategy. Next. So back in 2013, the McKnight Foundation board asked themselves, we were kind of switching from the baby boomers to the Generation X of the family, and the Gen Xers asked themselves, you know, these big, intense problems, we just don't have enough money. Our grants are a drop in the bucket of such enormous challenges. What else can we do? And they looked around and saw that they had an enormous stack of assets that were working for them, but not maybe working for them as efficiently or effectively as possible. And so this, they spent about a year on a board staff kind of process to look at options. They worked with Imprint Capital, which has now been bought by Goldman Sachs, and they established a program where they would carve out 10% of the endowment and try to really target higher impact investments that were closely aligned with program goals. And that was the whole idea. Let's just deploy 10% of the capital differently. What's interesting, though, is, you know, when people at McKnight or in other foundations look in the mirror and you ask them, what do you see when you look in the mirror? What they say is, I see a philanthropist looking back at me. That's our power. That's our influence. We are philanthropy. At McKnight, we've really worked hard to kind of say when we look in the mirror, we usually see a philanthropist reflected back, but sometimes we actually look in the mirror and what we see coming back at us is an institutional investor. And when you see yourself as an institutional investor, it gives you another set of options for leverage. And so rather than focusing just on how can we deploy 10% of our endowment, we started to say, well, as an owner of assets, we have leverage by deploying assets in ways that we think are new or different. We're a customer of a number of very large, very powerful financial service companies and some boutique companies, and we're their customer, and we can ask them to do things for us because they work for us. So we don't have to do all this work by ourselves. We can actually expect our fund managers to do the work for us. We're a shareholder, so we can vote proxies. We can support the kind of work that Laura and other really activated shareholders are doing, even if we don't have the resources to do that ourselves. And we're a participant in markets, so we have things to say to the SEC. We have things to say to stock exchanges. So this kind of higher level idea about what does our endowment do for us is what's allowed us to structure this program. Next slide, please. So when we look at that 10% of our endowment that we're trying to deploy for impact, what you usually see is impact investors want financial returns, and they have different kinds of degrees of how much they want. But what they also want is social and environmental impacts. However, the third piece that McKnight's board added to the expectations for returns is I am expected to deliver learning returns to the foundation. So, you know, our grant makers, people I work with have to get smarter and more informed about markets because of the work we're doing, and I have to rely on the learning that program officers have done and continue to do in order to shape our investment portfolio. And it's interesting that there's so much emphasis on the first two parts, but actually we've found that the learning return has been incredibly valuable and almost kind of exciting and life-giving. You know, our grant makers still have the same grant budgets they had before, but now they have another set of tools that are being used on the issues that they're also grant making in. So this is one of the kind of main frames that we use when we talk about returns is how do we provide learning returns. And then the last thing I'll say about the endowment in general, next slide, is by doing this impact investing with 10%, what we found between 2013 and the end of 2018 is, we've grown that bar of yellow investing, which is about $190 million that we've committed towards high-impact investing. But what's been fascinating is the act of doing that work has allowed us across the endowment to do the green segment of the pie, and that green segment are investments that are aligned with our mission. So maybe not making huge changes in the economy, maybe not exactly doing what our grant makers want us to do, but are actually getting our money to look more like McKnight's values. So whether it's about sustainability, going coal-free in our fixed income portfolio. So today about 1 out of every $3 is aligned with mission. And then one more slide, and I'll turn it back to you, Meredith. Another factor in how are we making this work with program gets back to the original point I made about kind of recognizing that you can't do everything and you can't express every value through your investments. The board, when they built the program, picked 3 grant-making areas, so the Mississippi River Program, the Region and Community Program for the Twin Cities, and Midwest Climate and Energy. They picked 3 programs, and they said these grant-making programs are most closely aligned with market mechanisms. It's where we see market interference causing some of the real challenges and problems we're up against. So that's where we want to focus our investing attention. It's not to say that there aren't opportunities in arts investing, there aren't opportunities in neuroscience investing, but we pretty much pared down the options so that the investment team could get to know and build relationships more closely with 3 programs and get to know 3 different environments for investing a little bit better. So again, trying not to do all things for all people, but to really focus on where markets matter the most. And we can stop there. I've got a few more slides I'll share later, Andrea, but good for now.
Thank you so much, Elizabeth. Absolutely fascinating to hear sort of the origin story to a certain extent of this approach. And you mentioned that there is sort of a transition in the generation of leadership, and there's sort of this, what else can we do? What else can we do? That was motivating this new approach. And Laura, was there something for the Nathan Cummings Foundation? What was the Was there an aha moment? Was there something where they said, we're going to try breaking the mold a little bit here. We're trying something new, and this is why?
Yeah, there definitely was an aha moment for us, and it came, I think, really way back in 2002. So I feel like it's legendary now, at least in some circles of the foundation internally. So our chief investment officer at the time, who had a background in investment banking, was going through a stack of proxies on her desk, and she turned to one that was a proxy for Smithfield Foods. And earlier that day, she had just been reviewing a stack of grants that she had to sign off on, and in that stack of grants was some funding for an organization that was working on something called the pork checkoff, which had to do with, vertically integrated huge agriculture companies and hog producers, and some of the unfair ways that they were operating versus small family farmers. And the light bulb went off, right? Like, on the one hand, she had this grant folder and this grant that was trying to address a problem, and on the other hand, we owned shares in Smithfield Foods. And I think for us, that was really the moment that sparked this desire to be more active. We've had a long history of voting our proxies, although we weren't doing it quite as probably intentionally in terms of alignment with our program areas as we might have. I think that moment, though, really catalyzed the desire not only to vote all of our proxies in more sort of direct alignment with what our program interests would be, but also to begin to use the power of the shareholder proposal process to drive change in the directions that our programs were trying to take it as well.
Not to keep pushing on your narrative, but do you know, is it the sort of thing where the idea was introduced and everyone just said, hey, that makes intuitive sense, let's go, or were there in between, or?
So we certainly spent a long time laying the groundwork for what eventually became a proposal to our board in 2002. So I joined the foundation in 2001. I was actually the assistant to the chief investment officer who sort of had that aha moment, right? And one of my first jobs when I joined was to spend a lot of time researching what other people were doing out there and what was best practice in this field. And then I think we really thought about how this could further our program interests while also protecting long-term shareholder value, in our opinion, and presented sort of a large proposal to our board that they then approved.
Okay, great. Well, I think it's sort of a natural lead into the question that Andrea really queued up quite clearly at the beginning of this conversation. Is, you said you've been doing this work for a relatively long period of time. I don't know, Elizabeth's sort of mandate is more recent, but in that period of time, have you seen a shift in your peers, either one of you, or how are you feeling like the rest of the philanthropic community is responding to these new approaches? I'll ask you both.
Well, so I certainly have seen a lot of shifts in terms of philanthropy recognizing the power of investments to drive change and also to do, I think, some damage, right? I would say that there has been pretty rapid growth in interest and in terms of practice as well in impact investing writ large. Unfortunately, I think with the specific focus on shareholder activism, we haven't really seen that same kind of growth, and we continue to struggle with why that hasn't happened. I think it's beginning to change, but slowly.
Yeah, I would agree with that. I mean, there's interest in impact investing because it's almost analogous to a grant. This idea that we have some money, we put it towards a project, the project happens. So I think it's easy for a foundation to see why, okay, maybe we want to put a few $1 million aside and do a little investing like this. I think it is much harder to kind of penetrate into the full systems of the endowment. I don't think investment investment offices aren't staffed for it. OCIOs don't necessarily outsource chief investment functions don't want to do it. And they're not paid to do it, honestly. A lot of investing staff get bonuses, and that this isn't part of their bonus. So I think one of the ways we'll see change is when boards start to say, yes, here's your bonus, investment staff, and X% is going to be linked to those 4 levers of change I mentioned earlier. How are you driving our issues through our fund managers? How are you driving it through the shareholder process? What else can we do?
Laura, I know you have opinions on that. You could add to, Elizabeth just sort of touched on some of the things that are holding foundations back, payment structures, staffing, knowledge centers. Are there other things that you would?
No, I absolutely agree with those. I mean, I definitely think that the incentive compensation structures for chief investment officers or outsourced chief investment offices do play a role in not only not allowing shareholder activism to be taken up in a big way by foundations, but just sort of like the integration of environmental, social, and governance issues and impact investing. And as I said earlier, I mean, in some ways it's short-sighted, right? But if you look at the way that people are compensated, it's also short-term earnings or short-term portfolio performance. So I agree, it's a big problem.
I also think there's a problem in that program staff. I mean, when I talk to peers at other foundations, I'm always surprised that the program staff can be very suspicious and untrusting of the investment staff and kind of almost consider that our impulses are always venal, and that if we're going to do this kind of work, you really have to put a lot of oversight over us because you can't quite trust us to do what's right. So it's interesting. I can think of some big foundations where their grantees or the grant makers are reporting out on grants once a year, and they're asking the impact investment staff to report out every quarter on impact. And that, to me, is just a fundamental lack of trust. So I think there are things program staff could do to kind of build more trust and be more welcoming to get the kind of cycle of collaboration going.
Elizabeth, can we use that to transition into some of the things that you're doing internally at McKnight to sort of create those learning?
So, you know, a couple things were accidental and a couple things were purposeful. So I'll talk about one of the accidental things first, which was because of various factors, we ended up starting with investments that were a little further afield for our grant makers. I think your impulse is get started right in the state of Minnesota, get up close and personal with the grant makers because then they'll really be into it. And actually we started kind of out far away and distant and got used to each other and established trust and built relationship and did some investments. And then I found when we got closer to home to make investments, there was a lot more at stake for the grant making and the program staff. For something that we were going to do right in Minnesota, they had a lot more opinions, a lot more concerns. There was a lot more stakeholders that could be that it could be a problem for. So I actually would recommend starting farther away from your core and your key and your deep expertise and get going first. And I think that really helped. That was an accident of our work, but it helped. Our first investment, just was not in Minnesota. Another thing, and then Andrea, I've got a slide that says Emergent Learning Table. So I wouldn't make an investment from the impact portfolio that didn't have support of the program. So the program is really important, and they are part of deciding whether something is relevant and worth the additional risk because we're going to get learning and we're going to get impact from it. That process has many times in which you're in contact together, and a lot of conversations happen with different program staff and at different parts of the organization. What we realized was that we were never taking all of those kind of fragmented conversations and bringing them together and acknowledging kind of what is it that we actually all agree that we're thinking and what do we think we've learned and what do we think we need to do more of. So we started a process where we fill out these things called Emergent Learning Tables. At the beginning and the end of an investment, we do them for investments we make and investments we don't make. And basically every program staff person and every investment staff person that was involved gets together. They're half an hour. We have a scribe, and we just have a conversation between us. We start with our hypotheses. So what's our hypothesis about this investment? Then what are the opportunities we think this investment will bring either to grantees or to McKnight or to issues we care about? What are data or stories that we have discovered or uncovered in our process? And then what are insights that we've gained? And so this table is from 2015. It's quite an old one. I've also taken out all the commercially sensitive information because obviously the Generate Capital cares a lot about what we say and don't say publicly. But I'll just highlight a couple things that are on this table because obviously you can't read it. Under hypothesis, one of our hypotheses was the work that this company does and their for-profit perspective may be important as we work with the Minnesota Public Utilities Commissions. So the regulatory environment that we're grant making into, we're going to learn things from these people that are maybe going to shape how we think about regulatory change. Under data and stories, it says Amy leveraged Generate Visit to for the pitch to gather local clean energy actors. So the people from this company came to town to try to sell us on this investment. And what we did was we got a bunch of our grantees together, and after the pitch, they went off and they had a meeting where they talked about different perspectives from where each person was sitting about energy policy, commercial insights. So we used it to kind of transfer information from commercial actors to advocates. And then under insights, it says McKnight must advocate for more robust impact measuring by Generate. So this is where I'm back to the idea of not being quite so, not always distrusting the motives. This company was not doing impact reporting. They were really stretched thin. It was hard for them. They didn't have the staff or the money to do it, but they were interested, and we basically decided we're going to go ahead with the investment because we think we can change them and we can get them to do much more impact reporting, but we're not going to let that stop us. We're actually going to enter into a partnership with this commercial actor and see if we can figure it out with them. And sometimes I think that foundations want every single contingent to be nailed down before they'll do anything on the investment side, and it actually gets in your way and inhibits you from having influence. So that's an example of our program staff was really generous and trusting of saying, yeah, we think we can move them, and if we can't, it won't be the end of the world. There's still, as this business grows, this business does good things, so we want it to grow.
Oh, it's a good one. I particularly like sort of that while they were coming to sort of pitch the investment, you brought them into a collaborative conversation with knowledge centers on the ground. I would imagine that given my own personal experience, when someone is trying to pitch you an investment, they are most likely to listen.
Yes, they're very willing.
And be responsive to the knowledge you're trying to offer them. But I'm also guessing that was probably really taken into consideration and maybe did shift the way that they did.
Well, we had the same experience with another investment, a debt lender into solar space, and when they were in town, they met with advocates, and what they basically said was, the Minnesota regulatory environment is not ready. This was years ago, and they were like, it is too uncertain for us right now to come in and do community solar, and so we're not coming here. And that was okay, but it was also something that was good for, advocates want to understand why capital's not flowing, and so it's good to hear that. It's good information, both directions.
Yeah, learnings for both sides. Elizabeth, we can tell because we've watched Andrea move your slides that you also may have a few examples of some of the investments that have been made. Do you want to walk us through those and just walk us through the process on both sides in terms of
sure.
conversations that were had today?
So this is a slide. I would say that we are not fossil fuel free. We have not made a decision to divest, partly because that was going to be a really hard decision to get, to kind of wrestle to the ground. So we just said, let's start decarbonizing. And so, again, not letting a policy decision get in the way, but actually saying, okay, what's the next wise thing? What's the next wise thing? So this is a decarbonization scenario that our program staff is using, and the circles represent kind of how much greenhouse gas savings we can get from these actions. So, big amounts from energy efficiency, fuel switching, and the grid, a little bit less from land sinks. So this is kind of one of their tools that they're using, and so I use these tools too. So if you go to the next slide. So in this is kind of where the big savings are. So our Region and Communities program that cares about the Twin Cities, they care about the built environment, so they are kind of the energy efficiency box relates to that program. And then fuel switching and decarbonizing the electric grid particularly is what our Midwest Climate and Energy program wants to be doing. So part of it is also there's a need for me to communicate back to program staff about what we've got in our different portfolios so they know what's there. And as they're doing their work, they may say, you know what, it would be really great to talk to an electric scooter company, or it really might be good to talk to a solar developer. So this is an example of kind of some of the investments we have. We've got private credit. We have a real asset firm. We've got a couple venture investments. That all relate to the work the program staff is doing. So some of it is also just getting them transparency into the portfolio and what's there that could be a resource or could be interesting to them. If you go to the next slide, that looks at, I think, land. So this is the more the land side of things, and that's the Mississippi River Program, which is interested in conservation of wetlands and other factors that prevent pollution in the Mississippi River. And these are examples of some direct equity investments we have or companies in our portfolios that have a direct play on water. Midwestern Bioag is an example of a $5 million direct investment in a soil services company where we do a tremendous amount of learning from them that influences the work we do with farmers. And then the third screen is, again, companies in our portfolio that are helping to reduce different kinds of high concentration greenhouse gases. So this is partly an example of how the work relates to different programs. It's also an example of the kind of information I have that I'm always trying to share back with program staff. I read these annual reports from investments, and I'm pulling data and information about markets that I want them to have. And it's up to them what to do with it. Sometimes it's totally not useful.
And just to be clear, these are all private investments?
Some of them are through fund managers. They're companies inside of funds we own. Some of them are direct investments we've made. And some of them are structured. One of them that you looked at was actually we were part of a private syndicate that was loaning money to a company that does low-income solar installation in Louisiana and Connecticut called Posigen. So the asset classes, I've shared a variety of things across different asset classes and different structures.
Okay. One of the questions that's come in on on the text, but also real curiosity is how are you both working with your fund managers, your external managers, the service providers that are involved with you in this? What are your expectations for them and how they interplay?
Do you want to talk about that, Laura?
Sure. I don't have too much to say, actually. I mean, we do all of our shareholder activism really sort of in-house with some assistance from outside people, but we're really the ones undertaking it. Our proxies are voted in line with the guidelines governing amalgamated banks' Longview funds portfolio. So, we don't really control that, although it's definitely in alignment with our programmatic values. I would say that over the years, we have certainly pushed fund managers, particularly fund managers that managed our assets, on their voting policies. And that's been a really important thing for us, and that's been an area where we've both focused energy and had success over the years. It actually hasn't been as hard as one might think to impact the way that our managers have voted their proxies over the years, and it's really important.
Yeah, we're in a lot of pooled funds where we don't control the voting, and we ask every manager every year to give us a report on how they voted, and I go through the report and I ask questions about why did you vote like this? When you get called on something you've done kind of in a routine way, you're more likely to pay attention next time. I sometimes Ceres and a number of international organizations have put out an investor statement on climate change that's now signed by some $23 trillion of assets under management. I sent that statement when it came out to every fund manager in our portfolio and said, I want you to sign this, or tell me why not. It's okay not to sign it, but if you don't sign it, tell me why. So trying to open that dialogue, open the consideration about kind of actions they can take that might prompt them to be more attentive. There's a blog on our website that I actually wrote about that experience and what kind of results we got. And, there are times when fund managers own things in our portfolio that we don't like, and I don't have screens for them. So I'll give you an example of an engagement. One of our managers had a private prison as a top 10 holding back in 2016. And whenever they came in, we talked about it. What's your understanding of this? What's the risk? This is what the risk looks like to me. What about to you? And the fund manager said really clearly, this was years ago, I think the risk of these facilities are the fact that they separate children older than 8 years old away from their parents, and I think that's a really serious operational risk. And I said, I completely agree with you. And we kind of opened this conversation up. A few months later, he sold the holding and hasn't had it since then. So, yes, he could buy it again. It could show up in our portfolio, but I would say that, A, we had a conversation repeatedly that kind of brought it to the forefront of their thinking, and plus, he's not just sold it for us, he's sold it from all of his clients' portfolios. So sometimes screening is a great thing, and sometimes there's other ways to engage fund managers that get you some kind of interesting results. And that's a question of philosophy, and I think both approaches are good approaches. One's not better than others. They're just different options.
You sort of naturally segued into one of the questions that came up on the chat, which is also a good time for me to remind folks that they can issue questions through the chat. But there is, the views on divestment as an approach to mission alignment for your foundation. Controversial one.
We're decarbonized. We're decarbonizing. We haven't divested. Recently, we did ask all of our separately managed account managers to sell oil sands stocks. So, we always say, what's the next wise action in the portfolio, and that's what we turn to next.
So, I think that divesting from certain industries is a way to achieve better alignment between your mission and your endowment. That's effective, right? Where I have some questions about it, though, is whether or not it actually results in changes to the underlying problematic behavior or industry. I think divestment campaigns, particularly around climate, have been really instrumental in raising questions about what is particularly a foundation's responsibility with respect to the assets that it holds. But, you know, from my perspective, I think that sometimes choosing to stay engaged and choosing to stay invested can lead to greater changes. I also think it's hard to divest out of, you know, an issue like climate change in some ways, because you have really large emitters that don't actually hold any of the carbon reserves, right? And so if you're following like a strict carbon underground 200 or whatever it is, you're still going to have a lot of emissions associated with your endowment.
Yeah. Andrea had sent me a side note that he had something to say. He wanted to know when he could jump in. So Andrea, do you want to jump in now?
Well, it wasn't so much that. It's just like I wanted to ask if it was okay for me to also bring up something in the mix of the questions. But given that I'm a bit of a broken record, I want to make sure that, you know, other people get to chat, get to share their points as well. Highlighting a couple of points that came up for me. One was based on Elizabeth's comment around the, if we can call it the signaling function that the foundation can play, right? In terms of lifting up to some of the fund managers that these are real concerns that are coming up, regardless of the ultimate choice of which manager to go with. And we've seen it playing out in several industries where there is a positive effect in terms of moving the entire field forward by almost causing this race to the top, to the earlier point about when they're raising money, they're a lot more willing to do stuff, right? So if they see as a potential investor and you say, oh, and you know, the other fund manager that we've been talking to has this really interesting impact methodology, or is thinking about things in a different way, right? Might be a way of socializing the ideas when they are actually open to and receptive to them. And that is a form of that impact management also, I think, in terms of not just looking at the perfect, but looking at the ones where there is this delta that the investor can contribute to on the impact side, or how good these practices are. Right? I imagine that if all the good foundations were investing only in best-in-class type of impact, we would be missing out this opportunity for actually driving the change a little bit by supporting the ones that can use the help in moving up. And the help is not just from the capital, but it's also from sharing those practices, as we were saying before. Right? It's kind of like a 2 or 3 way learning. One thing that I wanted to ask if we can delve into, and maybe it is a little bit more controversial in some way, but I don't mind that. Elizabeth, you were referencing to the idea that, well, maybe some of what we're doing is not exactly what our grantees would like us to do. And I feel like that is one of the things that's really held back a lot of progress. And I don't know if people on the call or otherwise agree, right, that there is this sort of level of purity almost that can be an obstacle to some meaningful progress. And I imagine that might be more work for the grantees, if I can be so blunt, to understand a little bit that there are certain constraints, there are certain processes, there are certain fiduciary duties, right? You can't just dump stuff today and move it into something else tomorrow. And I'm wondering if any of you have any thoughts or have come up with any practices around how to really drive that balance, right? So that we're not just looking at little tweaks at the margin. We are very serious about moving towards what the grantees would want in an ideal scenario, but so they don't feel slighted or dismissed, rightly so. But also being realistic vis-a-vis what can be done and what one can achieve now. Mm.
So I will say from my perspective that in many ways that's part of the beauty of shareholder activism, right? Like it is not going to have perceptible near-term impacts on stock price or endowment value, but allows you to raise real risks that your grantees have been highlighting. And so for me, it's just one more plus in sort of that strategies bucket, if you will.
And I would say, I mean, thinking about our grantees, they're not a monolithic group of organizations that agree on the same set of solutions. I mean, we have some grantees that are very interested in moving levers of political power, others that want to bring private capital in to solve problems, others that actually are very, rightly skeptical of private capital and don't want private capital to come. So it's a little bit difficult if you're a broad-based grant maker who's exploring a lot of solutions to have an understanding of what our grantees would or wouldn't want. I think that there's a number of things in our portfolios that some would be really excited about and others wouldn't. So that is a consideration, and a lot of times our grant makers are building their own strategy for spending grant money based on a variety of different types of inputs they're getting from their the advocate market, if you want to call it that. I will say that there are times when the diagnosis of how a problem is solved from someone with a commercial perspective is different than the diagnosis from someone from an advocate perspective, and I'll give you an example of that, which is we had an approach to us. Someone wanted us to fund an intermediary that was going to help connect private projects that needed private capital with investors that had private capital. And the deal flow into our program was good enough that I said to the grant maker, like, I don't need an intermediary to do that. We have deal flow. Like, do we really need to build another organization? So that's an example, I think, sometimes building intermediaries where you're just going to sometimes have fundamentally different points of view depending where you stand in a system. So, it's good to know where you stand. And I also have a lot of examples of grantees that have come to us wanting me to invest in something, and I've said, no, it's not going to work. I don't like it, or no, thank you. And I've been absolutely totally wrong. So, I mean, part of this is also the interchange and the energy that comes from the exchange of the act of exchanging ideas and perspectives about how to solve problems. Some of the people that I have said no to, though, I've sent them to other people in the ecosystem that I thought might be able to lend them money or might be interested. So there's also kind of a matchmaking function that you can do for grantees. Even if you can't do what they need, maybe someone else I know can.
Thank you. And I think then there is a corollary to this, because in the same way as an individual foundation can't take on every sub-issue that a grantee might be interested in or sort of satisfy all the different angles, I think that's true at the field level as well, right? And if you look at this year's, as you saw, proxy preview report, right? There are shareholder actions on pretty much anything under the sun. Is there any practice around coordination among foundations, like saying, okay, this year let's all choose to go after the pay gap, or this year let's all put our attention in one area, or is it more, this individual type of practice?
I'm guessing Laura would love to have more people that wanted to coordinate on this.
Yeah. One of the things, Elizabeth, if I can just jump in, that thinking about, as Andrea asked this question, so one of the projects I've been working on with Transform Finance is we're looking at if there are ways to utilize the capital markets that go beyond divestment or engagement or sort of data integration. Like, could we be looking at the ways that the markets have shifted, since the 70s when divestment became a known tool, and have structure new opportunities. So could a convertible bond have a lower interest rate because there was more of an attention to environmental issue from the get-go, right? Could we think about that ahead? Maybe looking at volatility dampening as something that attention to social environmental issues provides as a benefit, right? How do we do this? Right? This is the project that we're working on. And when we began this project, we went to what I probably fall within your grantee set. And we said, what is it that you need from the capital markets? What are you not receiving, so that we could think about that as we looked for solutions in sort of on the investment side of the coin. And what I'm wondering about in terms of your own programs, and I hate to ask this as a leading question, But what are the indications of success that you would say, okay, we know that we're overlap is happening. We can see the overlap is happening. You know, what are the indications that you would have on your side? Say, okay, the weaving, we've woven. You know, how do you see that? How do you know that it's been successful? I'm thinking your grantee has to go beyond that.
Ooh, I'm losing you a little, Meredith.
There's a background noise that came in from. So the question was, you know, are there indicators of success that you would point to in terms of the relationships that your investment team and your grantees have? Like, what needs to shift in that relationship for you to say, okay, we've interwoven in a way that's successful? You know, what the grantees, they stopped just asking us for money. Now they're asking us for, you know.
Right. Well, we're having a lot more grantees come to us with grant proposals that are about shaping or utilizing capital markets.
Oh.
So that's one way that I try to be of service to the grant makers is they bring these proposals for me and say, well, what do you think of this? And I'm not a grant maker, and I don't have the same kind of, I would say, far-sighted kind of strategic vision on how you make that kind of change. So, you know, I said, well, you know, when I look at this from the place I sit, you know, this is what I think. But it may be that it is an awesome grant, even if it might not be an awesome investment, or these are the kinds of things I would need to see come out of this project for me to consider as an investment. So I think one thing is when we see each other as actual resources that help us each get our jobs done day to day, that to me is a real marker, that they bring me grants, I bring them investments, and there's kind of a loop. Or when something happens in the market, like President Trump announces that it's the solar tariffs are going to be, you know, they're going to kind of go for solar tariffs. I spent a lot of time with a bunch of fund managers saying, what does this mean for your business? And feeding that back to the grant makers, because they were hearing from advocates what it meant, but they weren't hearing it from fund managers and capital allocators. So I look for those places where we each have something to give to make a fuller story.
Okay. And Laura, since you are a grant maker.
Computer now before it dies.
Okay. And Laura, since you are a grant maker, you know, what would you say? Since you're talking to organizations who are seeking funds from you and also support from the shareholder engagement side.
It's really important is helping people to understand sort of what these strategies are and how they work, whether it's impact investing writ large or whether it's shareholder activism, right? I think there's still not a ton of understanding, particularly among the majority of grant seekers, about how shareholder activism and active ownership can work. And so, you know, that's changing in part due to efforts like this. But I think that's an important piece that's missing that could help things sort of work more cohesively together.
Laura,
Go ahead.
I was just going to say, with the story you told us about the Amazon report, was that something they had baked in from the beginning, that there would be a shareholder strategy, or did you kind of see the report and say, oh, we can work with this?
Yeah, so I sort of looked at the report, and, you know, one of the things that I've been paying more attention to, and I would suggest that anyone who's sort of interested in sort of better aligning program and investment pay attention to, is just sort of like, where are corporations or capital markets impacting work that your grantees are trying to do? And so any report for me that had Amazon emblazoned on the top, I was going to take a look at. And when I read through it, I was like, wow, these really are a lot of risks for the company. And it seemed like it might be a good fit for a shareholder proposal. But at the same time, I didn't want to take a grantee's work and turn it into a shareholder proposal if it wasn't something that they thought was going to be helpful. So we then worked with them to make sure it was something that they thought would be useful and turned it into a proposal.
So it's occurring to me just sitting here that one thing also to think about is, you know, I've got a lot of fund managers that have a lot of exposure to Amazon. Like, you know, when you see that and read, like, there are things like I could be sending that to a couple of my fund managers who have a lot of Amazon and just saying, have you seen this? I mean, this kind of, again, how do you put things in front of people who are making capital decisions, and that's not their normal reading list, right?
Right.
But there are ways I think we in foundations can facilitate some of that more too.
So I know I'm not supposed to be asking questions, but I actually have a question for Elizabeth, if I might. So you've mentioned quite a bit, like how you go to your fund managers or to individual investee companies and you talk to them about issues, you get their perspective, you put things in front of them. And, one thing I think I hear in terms of fears from investment committees is that if we go asking our managers or our investee companies or whatever a lot of pesky questions, they're not going to want to invest with us anymore. And I'm wondering if that's been the case for you.
Yeah.
If you think it's a common...
That is, I think, a broad-based concern. When I used to work for commercial fund manager, we would hear that from individual analysts who kind of owned relationships with companies, too. They didn't want us butting in and asking pesky questions because maybe that CEO won't make time for me next time. My experience with fund managers has been they absolutely love to talk about companies they own. Like, they're fascinated. That's what they do. So, like, this example of the private prisons, like, he had thought about it far more than I had. And he wanted to talk about it, but partly it was kind of bringing it in a way that was not like, how could you do this? But I was like, wow, this seems like a really risky kind of endeavor. How do you think about the risk? So it's partly meeting them where they are. I also make a point of reading materials that fund managers produce related to proxy voting or ESG and I always write to them and ask a question or say I saw this or I liked it. And they put so much effort into producing all these materials that their customers never read, that by asking about these things in a partnership kind of a way, I found that it really actually builds the relationship because they feel seen and appreciated, and they know we're paying attention and valuing the work they do for us. So some of it, I think, is the attitude in the meeting, which is always open-minded, partnership, knowledge sharing, not accusation. And then some of it is like we put some legwork into stuff they care about. And I do have one fund manager who thinks what I ask about and what we do is ridiculous and doesn't want to hear anything about it. And I know that, and I adjust accordingly. Like, know when you've got better, warmer pools to swim in. There are always going to be some that are just totally recalcitrant, and, it's not my top priority.
Yeah, and I think that, again, fund managers in their with their capital raising hat on are probably the same way as executive directors with their fundraising hat on, which is a position that I often sit in. And if a potential funder asks me, oh, what do you think about this? I definitely read the report and give it some very serious thought, right? So it is a way of using positively the power that comes with sitting on a pool of capital, whether it's investment capital or grant capital. One thing I think it fits with what all of you were saying in some way, including Meredith's mention of our project of around how financial innovation can be repurposed for this social change aims. Is that it's this issue around data and the type of information that, say, a fund manager would find to be relevant and actionable versus what the grantees might think of as clean, valid data. Has there been any sort of effort at translating that piece? And I was thinking, Elizabeth, to the extent that you were saying, here is how a fund manager or an investment manager generally would be looking at this issue. And that can inform the type of information that comes up from the grantee side, so to speak?
Yeah, that's an interesting. I would say that kind of my day-to-day work, I'm so much more focused on the program officer as my customer. The endowment's my first customer, the program officer is my second customer. And I haven't structured my thinking. I mean, this conversation is giving me a lot to think about, to what degree is our grantee a customer too? They're definitely, I will meet with grantees about projects that have an investment like connection and see if I can help them find the right person. But the notion of kind of what do they have that we want to kind of move up into the fund management is not something that I've thought enough about. So this is a really good you're opening a really interesting line of thought.
But it could also be derivatively what the program officers are thinking about, right? Because much of their information probably would come from their work with people in the field or with grantees, and oftentimes I imagine it's not either framed in a way or formatted or of the quality and consistency and reliability that a fund manager would be able to act on, right?
Right. It's not comprehensive to the sector. It might be about one. I think that question of what do you know and is it presented in a way that's useful for this other purpose. A lot of times, though, I think our work is just introducing kind of grains of sand into oysters and, letting the fund managers kind of, they hear it from me, they hear it from someone else. It starts to become a trend, trend of two, but.
And Laura, if you wanted to address something along those lines as well, otherwise no.
No, I mean, I think the only thing I would say is add on to Elizabeth's comments about, it starts to become a trend of two, right? And if I think back to when I first started doing this work in, 2003, 2004, I mean, some of the things that we've been seeing, even coming from, the world's largest asset manager, right? I think would have been unthinkable to us back then.
Unthinkable.
Yeah. And so, yes, like we planted a lot of different grains of sand in a lot of different places. But I think if you look at where we were back in 2003 and where we are today with Larry Fink saying, like, if you're not paying attention to these social implications, your company's going to stumble and you may fail. Those grains of sand have had a big impact.
So, Andrea,
Yeah, maybe I'm mindful of the time, and you've all been extremely generous. So as a closing thought on my part, and then I'll turn it over to Meredith to close this, then I'm trying to see what does this conversation tell us about what is unique about foundations. I really like how Elizabeth was thinking of it as foundation as an institutional investor in some ways. So is the role that they can play more that they can start these trends and accelerate them, or how would you view it? What is it that is different about, $1 billion in a foundation versus $1 billion elsewhere?
I personally think and I think it's what's so frustrating about foundation world, Meredith alluded to it earlier, is unlike most other places like a university, all of your stakeholders have different values. The beauty of a foundation is all the staff and all the board, like you've agreed that we all share this common set of values. And it's very rare to be in a big financial institution, like think of a church or a temple where you actually can say, yeah, we agree. And I think in a foundation, we really do agree. So it's a little bit, it's unique and it's powerful when you finally kind of figure out how to break down the wall between the program and the endowment, and you can move quickly because you do share values. It's just that wall has been really, really tall and really thick.
Yeah, that's a really great insight, Elizabeth. I think it's true that we all do share values when we come to a foundation. I think the other thing I would say is just that we are also in very frequent contact with grantees and people thinking and working about some of the environmental and social issues on a daily basis.
Yeah.
okay. Well, I want to be grateful for the time that you've both given us today. I know as leaders and innovators and groundbreakers yourself, that means every minute is precious. So your willingness to share these minutes with us is really beneficial. From my own perspective, and when Elizabeth mentioned about Laura's work, that there certainly is a great desire for foundations involved in this space on the impact investment side and shareholder engagement and advocacy, and have those resources exist. If there's anyone on the line wondering, exist to begin, they do, and they can be easily captured to help folks forward doing it. But for now, I just want to thank you both for the time that you spent being such wonderful guides and for letting us sit in the master class and learning about the work that you're doing.
So Meredith was cutting off towards the end, but I think she was saying, yeah, that there are resources for foundations that are starting to move in this direction, if I understood correctly. And thank you, our speakers. Thank you also on behalf of myself personally and of Transform Finance, Elizabeth and Laura, for joining us and for all the great work that you do. And thank you, Meredith, similarly, for convening this conversation and for all the incredible work that you've been doing in this space. I think you are one of the few that really sits in that very interesting intersection, and your work has been fundamental to make any movement here. So thank you all. I look forward to continuing the conversation. I think there's a lot of work still to be done. I'm glad that you're out at the forefront.
Thank you.
Thank you. It's a pleasure.
Take care.